All right, Matt, the mortgage guy, live Q&A Monday night. We are coming off Thursday being the largest single day mortgage improvement most of us have probably ever seen, right? It was something in the neighborhood of 200 basis points improvement. For those of you who aren't, mortgage nerds, for all intents and purposes, rates got about 0.5% to 0.625 better in rate. If we go to our old trusted Mortgage News Daily, which gives us kind of an estimated rate from across the country, I think that last Wednesday they had it at 7.22% for the 30-year fixed, conventional primary residence kind of average. Thursday, that went all the way down to 6.62%. I know that 6.62 isn't necessarily enough to get people excited, but a drastic improvement from where we were at. And I think it's worth talking about. I made a video that'll probably be out later in the week. Where do we go from here? I think that's everybody's question. I was out this weekend talking to real estate agents, walking through open houses, kind of getting the lay of the land and a feel for buyer sentiment, right? Do buyers feel like this is just a blip and that it might be short-lived? And so while they can get 6.5%, really, close to a 5.99 with a little bit of rate buy down or a little bit of seller credit, and they want to buy something while they've got that opportunity? Or do we think it's the start of a new trend? Rates are going to go down in the future, and they can see, a Q1, Q2 of next year future with a 5 handle in front of rates, which, although it might not sound to a lot of people like it's that exciting to be in the 5s mortgage rate wise, especially those who are around over the last 3 years and they were locking into 2.875s and 2.75% 30-year fixed rates. I can tell you from a mortgage originator's perspective, from somebody who works nationwide with people, that 5.5% is significant. Above 5.5%, we saw demand really wane. We saw people, for whatever reason, whether it was affordability, whether it was buyer sentiment, whether it was a combination of the two, buyers really started to back off when rates eclipsed 5.5%. And some people might even call that tipping point 6%. So if we come back down, we are going to get demand back into the market. So the things you want to look out for and the things you want to be paying attention to, if you're a real estate investor, if you're a fellow loan officer, if you're a real estate agent, if you're anybody who's concerned about real estate, the real estate market, mortgage rates, I'll tell you some dates to mark on your calendar. December 13th is the date the next inflation number comes out. So November's inflation reading will come out December 13th. If it comes in lower than the current inflation number, which was 7.8, and we see a continued downward trajectory of inflation, rates will follow. The Fed will continue to ease off on their, tightening of monetary policy, aka rising of interest rates. The day after that inflation report comes out on December 14th is when the Fed has their next, rate update, the end of that next Fed meeting where they announce how much they're going to increase the Fed funds rate. Currently, everybody's got 50 basis points marked down. Everybody's expecting the Fed to do 50 basis points. If they do less, that will be downward pressure on mortgage rates. If they do more, that will be upward pressure. Whether they do less or more or as expected is going to hinge a lot on the inflation number that comes out the day before, right? And like I've said on this channel before, but it bears repeating, they will undoubtedly talk about what they're going to do in future meetings. They've already said 0.5 in the December meeting. February 1st, when the Fed announces their next 0.25 or whatever that ends up being, if those things change or if they're starting to project out into future meetings in 2023, what they talk about will affect mortgage-backed securities, will affect rates. So good things to think about, good things to consider. I'm going to answer this question, and then I'll pop in with my feelings on what you should do if you're a buyer in this current market, what the buyers that we're working with are currently doing, and a lot of success that I'm seeing with that. We had multiple offers go out over the weekend. We had buyers across the country who are getting great deals. We're negotiating really good terms, regardless of where the market goes. And that's why this question is a really great one. Nicole Jansen's, if I buy now but prices drop 10%, can I refi if I'm underwater if rates drop? Great question. I don't want to skip to the punchline, but the TAM bomb put it really well. Why not ask 10% less now? Which is exactly what buyers are doing, Nicole. If you've got something listed for $550, it's been on the market for 45 days, buy it for $500. Then you've essentially de-risked yourself, right? If that thing appraises at 550, or if it's, got some comps in the neighborhood that are at 550 and you're able to get it for 500, if the market goes down 10% and it's worth 500, the answer to your question would be yes. You would be able to refinance if rates went down. And this question also is going to depend on how much down payment you have. If you put down 3%, it's a lot different equation with the market potentially going down 5 or 10% than if you put down 30, right? If you put down 30%, you are probably in a position, regardless of a 5 to 10%, decrease in home prices, able to refinance. If you put down 3% and you buy it for 500 and that thing appraises for 480 in a year from now, you wouldn't be able to refinance. And I'm not the one to come out here and tell you, don't worry about it, everything's fine. You're going to be able to refinance no matter what, because in those scenarios, you might not be able to. And I say might not because there was something that I talked about on a past video where the CFPB actually put something out. They put out these, I think they call them polls, where they're asking for the public's feedback based on things they're trying to implement. And one of the things that they put out, let's see if I can try to find it real quick. They put out something where they were looking for feedback on, it's called a request for info. And so the CFPB put out a request for info where they were asking for people to give feedback on targeted and streamlined refinance programs. And it was basically using terminology that would point towards your situation, right? Where we were in a market where rates had gone down, but home prices were at the same level or slightly decreased to where it made it hard for somebody to refinance. I'm going to read this this line from the CFPB because I think it speaks to this. Mortgage products with automatic forbearance features may help ensure that homeowners whose incomes or financial situations are affected by events, blah, 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 blah. That's not the one. Innovative refinancing products, such as automatic refinancing, targeted and streamlined refinance programs. I know for certain I read in here about basically refinancing folks regardless of value. And this automatically sparked in my head the refinance program that was around, HARP, Home Affordable Refinance Program, in 2011, 12, 13, I believe it was. When I very first got into mortgage, you could refinance even if your loan balance was 130% of what you owed. So the answer to your question is maybe not, is the truth. If there's programs that allow for it, then yes. But ultimately, the best advice for you is go out there and find yourself a deal where you're insulated against a downward drop, right? Go out there and find yourself something 10% below what they're asking, so that if prices do drop by 5 or 10%, you're still at par, right? You haven't lost anything. Natalie, what's up? What's up? Thanks for joining. One of the best closers in the game. I appreciate you more than you know. It is super exciting because with rates coming down 0.5%, I know rates aren't, fantastic in a lot of people's eyes, but a scenario I'm looking at right now, that 0.5% in rate betterment is going to equate to $211 in mortgage payment. So either the buyer's going to get a payment with $211 less in monthly payment for that same house they were looking at just last week, or if they'd like, they're going to go and be able to afford $40,000 more in house for the same mortgage payment. Either way, rates coming down is a win for the buyers. On November 22nd, I have a class coming up, and I'll leave the link in here as soon as I can find it. The magic of the 2-1 buy down. This is for real estate agents. This is for consumers. This is for fellow loan originators. Feel free to join me, rip off my stuff, go present it at realtor offices, whatever you want to do with it. As long as we get the word out, the 2-1 buy down is a super strong tool for buyers. It's a strong tool for sellers as well. And you might ask yourself, like, well, what does it have to do with sellers? Sellers who can't sell their house, if they give a credit to a buyer that allows the buyer to have a 399 for year 1, a 499 for year 2, and a 599 for year 3 through 30, that's a win. They can get a buyer into the house that thought they weren't comfortable with the payment, thought they didn't, want to buy the house because of current mortgage interest rates. The way you structure a mortgage matters. And that ultimately is what's most important to most buyers, monthly payment. So 2-1 buy down class. I'm going to try to pull up a link here. Hopefully I can find it without fumbling too much, but it's going to be on November 22nd, a couple days before Thanksgiving. A lot of people will be taking it easy that week, which is the game plan. Not a lot of things going on. Pretty slow work week for a lot of folks. And so you'll have some time to kick back, relax, grab some lunch on November 22nd, sit down in front of a computer. It's going to be at noon on November 22nd. Here is the link. Copy and paste. Go sign up there. It's going to be an awesome event. I'm excited about getting a couple hundred people on that thing to go over the magic of the 2-1 buy down, how it works. If you're a real estate agent, how you present it to your clients. If you're a consumer, how this will affect you and your payment and all those things that go into it, because ultimately it's a tool to help sellers sell, and they can give $8,000, $10,000, $12,000 in seller concessions, which is going to save the borrower hundreds of dollars per month. It's much, much better for a lot of people than strictly using that credit to buy down the rate permanently. It's especially the right product if you think that rates are going to go down in the future, which I tend to believe. If you go back across some socials, literally called the inflation number that came out last week, called what was going to happen with mortgage interest rates. And I think we see more of it in the future. I think that interest rates in the 5s in Q2 of 2023 is a likely possibility. And people would have called me crazy even last Wednesday. As of last Thursday, I look less crazy, right? And interest rates coming down seems more plausible because we've already seen the beginning of it, right? I think that it was well said by a friend of mine. The Fed pivot, which is kind of like a turn, right? The Fed has been nothing but tightening, interest rates going to the moon. When they pivot, which they will, it's going to come in 3 steps. Step 1, slow down the current rate of rate increases. We've got 50 basis points slated for December and 25 slated for February. If we do that, that's already step one. We might even start the slowdown quicker. If for whatever reason December 14th turns into a quarter basis point, then we're well into step one, which is slowing down. Step two is a pause where the Fed does not increase the Fed funds rate. They get to whatever rate on the Fed funds, 4%, 4.25%, 4.5%, that they feel has done the necessary work to pull down inflation. And then step three is when they actually move the Fed funds rate back down. A lot of people think that since a lot of these numbers lag, we're going to get to a point where they can go, oh shit, we over tightened. We're going to have to lower interest rates. And so step three, we'll see interest rates come down, whether that's Q2 of 2023, whether that's Q3 or Q4, yet to be seen. But we gonna see. Sierra Smith, thanks for joining. I appreciate you. And I think this is probably something that you're spot on about. Like, little bit of rate drop. Things are a little bit more affordable than they were just last week. 0.5%, as we've seen on the uptick, when it goes up by 0.5%, it has quite the impact on the monthly payment and affordability. It's going to do the same on the downside. So we've got this paired with the seasonal slow in the market. There is going to be great deals. Like your comment with like, hopefully it's going to lead to a great deal soon. I promise you, Sierra, if you're looking, if anybody is out there looking for great deals, they are coming. We're just not all going to get them, right? It's going to be the people that are at the right place at the right time with the right strategy, and truly ready are going to find good deals. I've already seen some pretty smoking deals. I don't know if I shared this in last week's, but it's worth sharing. There are certain builders. And at the end of the day, builders are just sellers of real estate. They're just like Aunt Betty, who's selling her single family, except for they've got a lot of them, right? They are some highly incentivized and highly motivated to sell, others in between, and some could care less and they'll pull it off the market if it doesn't sell, right? A certain builder, and I'm not going to name the name. I think it would be probably not in good taste to name the name, but talked to an agent who said these specific units, this site that they built with these homes, they're highly motivated to sell. So highly motivated that he was able to negotiate $85,000 off on price, $15,000 in credit to buy the rate down, and like another $10K in incentives. So over $100,000 in builder incentive. That's how bad they want the stuff off their books in 2022. So builders are going to be in a position where they're offering great deals. You said it, Danny. All right. I wasn't going to name names, but Lennar Homes is literally fire selling some stuff. And I mean, fire sale is probably a strong word, but $100,000 off of a $600,000 property, that's whatever that number is, 17%. That's a fire sale. You let the cat out the bag, Danny, so I had to name him Lennar. And I should mention, depending on what kind of credit you can get, their in-house incentives aren't that good for using their lender. So call us. We'll do the loan. I had one recently where we priced side by side, and even with the builder incentive, we were better. And from what I've heard from internal people at Lennar, their mortgage department ain't that good. All right, Colin Van Coolen, thanks for joining. Better time to buy today compared to early to mid 2023. I do not need to buy a house right now, but I have a house that I could get into contract right now for 4.25% under listing price. Well, this is a great question, Colin. And I love answering honestly. I'm not going to give you an answer that you would expect from a mortgage person or from a real estate person who's like, it's always a good time to buy. The best time to buy was 20 years ago. The second best time to buy is today. As far as 4.25 under listing price, I cannot stress enough to people that listing price means absolutely nothing. If I've got a house that's worth $600,000, if I listed it at $550 or $500, you shouldn't expect me to discount it. But what if I decided to list it at $800 tomorrow? Would somebody come along and be like, listen, I'm getting this house for 20% below list price. I'm only paying $640. This guy's got it listed at $800. So in that case, it's like 20% below list price would be a terrible deal if it was worth 600-ish today. And so I think that if you're negotiating on, right now I have a house I can get into contract for 4.25% under listing price. What the smartest buyers and investors are doing right now is, one, get rid of list price because it doesn't necessarily matter. I would instead look at comparables. And the closer to today, the better when it comes to comparables, because March and April rates were different, right? So someone could pay $600 and have a much better like payment than you can have buying it $525 today. In a lot of places, I think in Sacramento, like we've seen a 12% reduction in price from the peak, the tippity top peak, which was inflated. So that also shouldn't hold all the weight either, right? Because like someone's able to pay this much because they got a 2.625 30-year fixed. All of this to say, like if you're going to go out and buy something right now, get a great deal. And really that's all I'm seeing put together. I'm seeing, somebody offer 10,000 below list, 15,000 in seller credit, and they're in the game, right? The current meme that's floating around is showing people that if you had a $400,000 home that went $100K above list and sold for $500, you'd be better off today. It's because you can get that thing for $425, and you're essentially going to have a similar payment, even though it was 3.5% and currently it's 6.5%, something to that effect, right? So it's really hard, Colin, to answer a question of like, should you buy now or should you buy early to mid 2023? Here's something I'll say. If you're able to shop and negotiate and find amazing deals currently, what you might find is if rates continue to go down, I think they will, come March or April, you might have a better interest rate, call it 5.5%, but that lower interest rate might inject some demand back in the market. I will never claim that we're going to be in 2020 and 2021 territory when it comes to demand and 20 offers and like all the crazy stuff that went on. We won't be there, but I think that demand will at the very least put a floor on how much home prices can go down. If something is got comparables of 500,000, again, I'm throwing out list price. If it's got comparables at 500 and you're able to buy it at 470, you're baking in if home prices decline by 6%, you've already baked that in. You've already got yourself a 6% discount under comparables. And I think that's what you do, because it's more likely that we see home prices decline than it is that we see them increase. It's probably more likely that we see a 5 to 10% reversion back to reality than it is we see home prices stay flat, to be honest. I was on the flat train for a while with everything I'm seeing, and demand is as quelled as it is at current interest rates. Like 5 to 10% decline in home prices seems a pretty sure bet. And so bake that into your offer. I think that's my best advice right now, right? If you can't get that offer today, then maybe you wait. You just don't want to wait under the false assumption that you're going to be able to get a lower price and a lower rate at a future date. I don't think that's guaranteed either. I think that as rates come down, demand comes back. It doesn't create a 10%, home price appreciation in 2023, but it creates a floor to where like we stop and it's flat, or we stop and we only see a 4% home price depreciation and not 10, 15, 20 like some people seem to think we're gonna get. Dalton Pierce Spear, I appreciate the kind words. I appreciate you following and watching. I shared the link. Jump on, invite realtors this coming Tuesday, November 22nd at noon Pacific Standard Time. We're going to do the magic of the 2-1 buy down, how buyers are winning in this market. I really, really think that product is just the win-win for everybody in this current market. And so I'd highly suggest checking that out for everybody. Landon Moto 39. Thanks for joining. Appreciate you. Have we shifted to a buyer's market? That's a great question. And you got to preface this with, there's a lot of different markets. There's a lot of different dynamics going on in a lot of different metros. Sacramento, where I'm at, is, a great market for a number of reasons. I even saw us on the top of a list for net migration. Like we've got more people coming to Sacramento than any other place. A lot of them coming from the Bay Area. If I look at Altos Research, who does a great job of putting together really good data, they've got a market action index, right? Seller's market goes all the way to 100, buyer's market down to 0. They literally put the determiner at 30, where if it's above 30, it's a seller's market. If it's below 30, it's a buyer's market. Sacramento's at a 48. And you could look all across the country. There's going to be some that are at 32. There's some that are 60. There's some that, are all kinds of different numbers. Rates are not coming down. Do you listen to the Fed? Property prices will drop based on the area. Okay. Why is the buy down option a scam? I am open, Mr. Kevin Hughes, to really having a conversation about this on why it's a scam, because we can get into it, but a 30-year fixed is essentially what it is, with a discounted payment in years 1 and 2. So I'd love to hear your thoughts on that. I actually had a account executive who was talking to me about why he didn't believe the 2-1 buy down was a great option on conventional loans. He believed in it on government loans. And so we had a great open discussion where I'm always open to hearing what other people think. So let me know what you think. We'll have a good conversation around it. If you want to come on live on video, we can even do that. Do you think the tech layoffs going to affect the Sacramento market? What's funny about that is with Silicon Valley and San Francisco being a huge, tech hub as it has always been, the tech layoffs might have a positive effect on the Sacramento market, because Sacramento gets a lot of Bay Area transplants. It gets a lot of spillover. And I know that my buddy Ryan Lundquist would probably, debate me with some stats on this, because it's like, it's not all Bay Area migrants for Sacramento traffic and Sacramento incoming, but whatever that, I gotta find that Redfin. I believe it was Redfin that did the study on where they were coming from. Sacramento was number one that list for incoming. Okay, so refinance later nonsense that realtors keep trying to push is non-fence. When prices drop further, buyers can't refinance. Well, you might have a point that, like, it's not guaranteed that you can refinance, but I'm also not buying into 30 and 40% price drops like a lot of these, doomsdayers, fear porners. Joey Garessi, how about them Sacramento Kings, bro? How you like them apples? Started off 0-4, 6-2 in our last 8. We're back to 500. So, man, we are looking good, bro. I think, what did we decide? January is when the OKC's playing the Kings. You got to make a Sacramento trip. Sacramento's not very nice in January, to be honest, but come on out, brother. Come check out the Sacramento Kings. What are the Thunder doing? I haven't even looked, man. I've been busy with this. I got this mortgage thing I've been doing. But yeah, is OKC doing all right? Is the Thunder doing okay? Where'd Kevin Hughes go? Here's the link, Kevin. Come on down, brother. Go to StreamYard, click join. I'll throw you on. I got about another 20 minutes to my next appointment. We could talk about the 2-1 buy down. I'd love to hear why it's a scam. I always love those conversations. Those are the best. Like I said, I had a good conversation with somebody who I love and respect in the mortgage industry, who has got a different opinion than me. He's looking at 5 and 7 year arms and pitching those versus the 2-1 buy downs. Which, speak of the devil, when would you recommend 5-year or 10-year arm? Honestly, these arm products, pros, cons, aren't priced well enough versus the 30-year fixed, where it makes sense to most people getting conventional conforming loans. Where I would recommend it is in the jumbo space, where a 1% spread on rate could be $1,000 a month difference in payment. And I only recommend it when somebody has a clear exit plan, right? And there's plenty of people out there that have 8-figure net worth that are still leveraging real estate and saying, I'd rather pay $1,000 less per month, and that money's being put into investment accounts, than pay this higher interest rate, because in 5 years I'm going to do this, or in 7 years I'm going to do this. 7 and 10 years is a long time, but you don't want to be in a position where 5 or 7 years from now, your credit profile and your income doesn't allow you to refinance. I'm not one that thinks that home prices are going to be significantly lower in 5 to 7 years, but you have to think that that's a consideration as well. So not for everybody, but in my experience from pricing out 1,000 of these things, it's really mostly only making sense in the jumbo space. Dominique Hart, NC Realtor. Who do I know in North Carolina? Is Keena out there? I think Keena from U Mortgage is out in North Carolina. Gearinger, is that her last name? Whatever it is. If you know Akina from U Mortgage, you should be sending her all the business. Anyhow, the 2-1 buy down. Yeah, there she is. How do you say that last name? Geringer? I think Keena's in North Carolina. I just saw her at a mortgage event in Vegas. Great loan officer. So Dominique, the 2-1 buy down, while it doesn't directly benefit the seller, here's what it does. You've got a seller that is having trouble selling their house for $500,000, and they say, "Listen, Dominique, like if we can net 485, I'm happy, but I don't want to have to go down to 450. It wouldn't make sense. I wouldn't even sell my house if we had to lower the price to 450. If the price was 485, the buyer would probably save about $70, $75 versus the $500,000 price. Here's the magic. Your seller says, I'm going to offer $15,000 in seller concessions to buy down the interest rate for a 2-1 buy down. Now, with that 2-1 buy down, the buyer essentially gets 2% lower on rate in year 1 and 1% lower on the rate in year 2. And then in years 3 through 30, it's fixed. A quick example of one we just set up, 399, 499, and 599. So what that does for the buyer, they probably save $500 in year 1, $250 in year 2. And then it goes 599 years 3 through 30. It's not an adjustable rate mortgage that can go to 10%. That 599 is the highest it'll go, and it's fixed there for years 3 through 30. So contrary to some naysayers, it's not the worst thing in the world if you can't refinance this thing because it's 599. And I promise you, when you present this to buyers who are like, I don't know if $2,750 a month is it's a mortgage I could wrap my head around. Well, $2,250 for year 1, $2,500 for year 2, then years 3 through 30 is $2,750. We're straightforward with them. They have to qualify for the payment of $2,750. They just get to step into it. Maybe, the wife's getting 5% pay increase next year and the year after. So it's a little bit tight to pay $2,750 today, but they know they're getting, increases in pay at their job over the next couple of years, or whatever the case may be. Really, as a lender and as a real estate advisor, we're just presenting the options and we're showing the folks. Resoundingly, people love this, right? And so the buyer all of a sudden says, yeah, I can pay $500. You give me $15,000 in credit, buy the rate down. And now they're saving $500 a month in year 1 versus if I pay you $485 and you give me that $15,000 discount, I'm only saving $74 a month. It doesn't make sense. So it's the same net to the seller to sell at $485 or to sell at $500 with a $15K in seller credit. Those credits to activate that buy down, it's different depending on the interest rate, the loan amount, and all the other things. And the lender can do the calculation for you. Maybe it's $9,862, $10,552, whatever it is. Like, that's how it benefits the seller, is they're giving something to the buyer that allows the buyer to say, okay, I'm comfortable in buying. Hopefully that straightened it up for you. There you go, Natalie. Shout out for our girl, Keena. I hope she's in North Carolina. If I was wrong, if she's somewhere else, then I'm just getting old. I'm just going to blame it on me being old because she might be in South Carolina, but it's still one of the Carolinas. I was close, right? Can you combine a 2-1 buy down with a 10-year ARM? You cannot. It's only the 30-year fixed, but it can be FHA. It can be VA. It can be conventional. It can be multiple different loan productos, otherwise known as products. Joey Garessi, did both Fannie and Freddie said they'll be given the interest rate discount for first-time home buyers starting in December? Home Possible and Home Ready, right? Yes, sir. Home Possible and Home Ready both. So if you're a first-time home buyer, if you're within those area median income levels, you're going to get a discount on your rate and fees. To keep it really simple, if you fall into that bucket, the lenders strip out some of the costs. Loan level price adjustments is the fancy term for mortgage folks that want to feel fancy, but it's just maybe the rate is 6.5 and, first time buyer, it's 6.25. or 6.375, and no fees versus, the regular rate is 6.5 with 1,500 fees, whatever it is. First time home buyers, you're getting a little bit of, help, because FHFA and other agencies understand we want to make homeownership more accessible. Can you do 2-1 on a jumbo? That's a no. You cannot. Thanks for the question, Tim Mack. Thanks for joining. VQuez, thanks for joining. Appreciate you being on. Any and all questions, fire away, folks. I've got 16.5 minutes until my next appointment. So I'm going to try to answer as many questions as possible. This is not a question, but a statement. Numbered, weighted, divided. Armageddon is happening, the housing market. That's what's going on. Well, you heard it here first. Armageddon. Please extrapolate. Last time I asked somebody to extrapolate, my buddy Kevin Hughes just hit the road. He said the buy down option is a scam. He's invited. He's invited next Tuesday to the magic of the 2-1 buy down. He gonna learn. All right, thanks for that, Natalie. Keena, Michael Wolf, and Mike Alberico, all in NC. I live in the DC area. There are empty houses all over Northwest DC. Why are they empty? High balance? Yes. I'm 87% sure. I always speak the truth. And the truth is I'm not 100% sure that you can do it on high balance loans, but I'm 87% sure you can. Is your brokerage doing HELOCs on investment properties? No, we are not. I don't know anybody that is. I can reach out to some lender contacts. HELOCs on investment properties. I would guess that there's not a lot of lenders lining up to do that, just because it's high risk, very high risk. All right. A few look like investors might have given up on renovation. A few have vacant property notices. I call those the neon green sticker of death. Okay, be interesting to see. I would probably venture to say, with as easy as money was and as easy as flipping was, there's going to be some flippers caught with their pants down. So there's going to be some of these. I would almost say, well, depending on what happens to the economy in the next 6, 9, 12 months, there might be more foreclosures from failed investors than, families that are struggling. Because, I'm not blind to the fact that inflation has caused some harm to people that were living paycheck to paycheck, that, the layoffs that are happening across different industries are affecting families. And so to think that these record low foreclosure numbers will last forever is overly optimistic. But I think that there's going to be some investors caught with their pants down as well. I put these on to drown out the background noise. I'm easily distracted. I'm like a squirrel, or I'm looking for squirrels. One of the two. Yeah, Joey, I think that like you probably did some research, probably poked around a little bit and looked into like where can you find HELOCs on investment properties. Few and far between. And if you find them, it's probably going to be 10% interest rate. Bank of the West sounds like. Joey, I did not take a bow. I think I'm going to try to connect with Zuber tomorrow because I've got live continuing education for my mortgage license on Wednesday. So I'm not going to be able to connect with them Wednesday. And so we'll have a good, fun laugh about. He's generally right 90% of the time, and I'm wrong all the time. So the fact that I was right, like I can gloat a little bit, but not too much, right? Because in general, he's more right than I am. But yeah, if anybody missed it, I took a shot and guessed CPI numbers, so much so that I released a video on Thursday that I had made on Tuesday. I showed proof that I recorded it on September 8th. I thought inflation was going to come in low. I thought interest rates were going to come down. And it would have been more impressive if I posted it Wednesday. I don't want to put too much pressure on the marketing team, but I nailed it, right? A total wet blanket. I mean, I don't even mind it, right? It's good to have multiple points of view, right? Where you've got some people that think the market is going to go down 60%. You got other people that think the sun always shines and it's just butterflies and rainbows and nonstop home price increase. I'm of the camp where I'm in the middle, right? Where home prices can and likely will continue to trickle down. The markets that saw the biggest uptick during COVID are going to see more of a pullback to some sense of reality, right? Whether that's 10, 15, or 20%, we'll wait and see. Markets that are stable, but also saw 30 to 40% home price appreciation, like Sacramento, we'll come back down 10 or 15% from the peak of what we saw. Because to me, it's simple math. When rates are 2.5%, I can afford to pay more than I think the place is even worth because the money's so cheap. Now that money ain't cheap, I'm not going to pay that number anymore. If you only have 1 year of self-employment, it's going to be really hard to get a conventional loan. If you've got 5 years self-employed and you only want to use 1 year of tax returns, that's a different story, right? Where you can do that. But if you're truly only been self-employed for 1 year, I hate to be the bearer of bad news, but I prefer to keep it 100, where chances are somewhere between slim and none. Sebastian, would it make more sense to use seller credits to pay for closing costs rather than going for the 2-1 buy down or permanent rate buy down? It all depends on what you're looking to do, right? And I could give you some rough numbers for context. If you're buying a house and 6.99% gives you credit even, right? Or let's use the rate that costs next to nothing. Let's call it 6.5%. And that monthly payment is $4,000. If you're comfortable with that payment, we can plug you right in. Don't pay anything up front, but you'll save whatever the number is. You get 8,000 in seller credit. You save that 8,000 up front. You get 10,000 seller credit. You wash out those prepaid property taxes and escrows and title fees and all the things, right? If you use that $10,000 to buy the rate down to 5.99, and now you're saving $220 a month, based on this loan amount. First, what's more important to you, $220 a month or the $10,000 in saved cost? And you can do some quick math and say maybe it's a 48-month break even. So if you stay in the loan for more than 48 months, it makes sense. It gets a little bit, multifaceted when you're thinking about, like, it's not your money though. It's the seller's money. So it's really personal on which one you want to do. The thing I like about the 2-1 buy down is if you buy down the rate as a permanent buy down, that $10,000 buys you to $599 in this scenario. And no matter when or how you refinance, that $10,000 is sunk cost, it's gone. If you get a seller credit that goes towards a 2-1 buy down, and there's $10,000 sitting in a buy down escrow account, you're going to save in year one. If you refinance, if rates go down, whatever's left in that escrow account comes back to you as a principal reduction. So that's the really cool part about the buy down. But if your biggest thing is just saving the money up front, then maybe use that to pay towards closing costs. I'm glad you caught it too. All right. Housing involved guys talk. I mean, question, Emmanuel, thanks for joining. I appreciate it. Can I get a mortgage with 5 months of work history? Also, what is the chance of a traveling nurse getting approved for a mortgage? Traveling nurses, great chance of getting approved for a mortgage. 5 months history, very small chance. And especially for a line of work like traveling nurse, great income, but it's variable. And anything that's variable, traveling nurses, to be specific, we're going to need a 2-year history. The lender wants to have enough of a history to look back and say, okay, well, this stint you had here, and then that stint you had, like, you're making about $7,200 a month working this traveling nurse gig, because the best guesstimate of what your future income is going to be is what you've made over the last 2 years. And so there's a lot of different jobs that are variable. You make $9,500 one month, you make $5,800 the next, then you make $74, then it's $62. They're going to take an average. And in this case, like, 5 months isn't a big enough history. They want 2 years. So unfortunately, the 5-month thing is really the thing that's going to hurt you. Traveling nurse, we do those loans all the time. You just got to have 2 years plus of work history. Okay, Joey Garesti. I was wondering if it sometimes makes sense as an investor to take a slightly higher rate and get a lender credit back. If the deal still cash flows, we think rates will come down, may work. Yeah, and this is the thing where, to your question and to somebody's earlier question about, like, should I do, the seller credit to cover my closing costs? Should I do it to buy down? If we all could be 100% certain that two things are going to happen: rates will come down, prices will be at a point where I'm able to refinance. That's something that, like, I don't want to personally guarantee somebody, right? Because you might buy something, Joey, where, you take a higher rate or even a credit, and you're like, all right, cool, I'll just take the 8.25 and I'll save $11,000 up front. I'm going to refinance it later. Rates come down, home prices are stable. You refinance it down to a 6.99, you win. The problem comes, like, what if you can't? What if rates don't come down? What if home prices depreciate by 10% and all of a sudden, like, after you put down 20, now you've only got 10% in equity and you're not in a position to refinance this investment property? That's where, it can get a little bit hairy. I can't believe anyone is still considering buying a house and taking out a mortgage right now. Just my thoughts. I mean, there's plenty of multimillionaires that are continuing to buy real estate. They'll continue to buy real estate. They'll continue to create generational wealth. They'll have tenants pay down their mortgages. And so they're having debt paid down. In 20 years from now, any house you buy 100% guarantees going to be worth more in 20 years. There's tax incentives for it too. Like numbered, weighed, divided, while we sit on different sides of this argument, the one thing that I know with absolute certainty is done right over the long term, real estate wins. And you could be correct and I could look like an idiot 12 months from now if real estate, goes down 15%. I don't think it's going to happen, but if it did, you might look like a genius. But I can tell you the stuff I bought in 06, I love it just as much today as I did when I bought it in 06. It looked maybe like not the best deal in the world in 09 or 2010 or 2011. I still own it. I got to refinance it. I've got great tenants. It's going to be worth the properties that I have today. Some idiot public school guy like myself who happened to put a couple properties into his portfolio, me and my wife together, right? Team effort, are going to appreciate over time. In 2 decades from now, by doing nothing other than owning real estate and letting tenants pay the rent, going to have multiple millions in paid off real estate and tens of thousands in rental income. And like it's a foregone conclusion. It's done. It's been written. You can't tell me otherwise. If nobody can steal my real estate like they can FTX, Bitcoin, and Ethereum, right? Like no one's going to hack an account and pick up a house and take it away. It's renting for $2,300 this year. Over time, it's probably going to be $2,600 5 years from now and $2,900 in a decade. All right. Last one that I'm getting out because I do have a 4:00 appointment, and this is a great question to end on. Dominic, appreciate you. $1 million to predict the rate on a 30-year fixed in May of 2023. And from a nationwide perspective, right, where they just say 30-year, this is the average today is like 6.65 or 6.62. If you were to pay me $1 million and if I got it right, I would get that $1 million. I would try to get it right. And my prediction would be 5.24%. May of 2023. I think 5.25. But I think I said 5.24 for this one. That's my guess. Yeah, maybe I'll tell more of my story later. Number, weighted, divided. Because I didn't do anything spectacular, but accumulate 12 doors over 15 years. And it's going to be easy peasy, multi-measies. All right. Thanks for watching. Appreciate you guys. GreatMortgageBroker.com. Go fill out the form, connect with my team. We're more than happy to help. I didn't share it all the whole time. What kind of lame-ass marketer am I turning into? GreatMortgageBroker.com. Fill out the form. Let us know how we can help across the country. We're more than happy to help. GreatMortgageBroker.com. Go fill out the form. Lousy job of marketing. Maybe I'll have to put this link in the comments. Thanks for watching. Bye-bye.